facilitated by Miss Angelina, who is ready to teach us tonight on the life side of this license exam. Anyone studying this week? Or taking the exam, should I say? Who's taking the exam this week?
I'm next week.
All right, Lydia. I see you, girl. You got this. Lydia, you reluctantly said,
You got this. It's an easy exam.
Listen, guys,
I don't know.
we are not worried. We are just excited to learn tonight, right? Where are you guys joining from? Give us a few. We have a few minutes. I'm from Georgia. I'm in Atlanta. It's a little bipolar with the rain. It's been raining literally 30 days straight.
Oh gosh.
We cannot.
Same. It's been raining in Colorado as well.
Colorado,
Really?
just nothing
Yeah.
but rain. I'm not complaining, but I'm like, oh my God, it's just humid and muggy, but it beats snow. Anybody in Chicago or getting ready for snow?
Already? You think
Yeah,
there's
Chicago's
snow
bipolar,
already?
too.
Oh my goodness.
Chicago, Illinois,
Illinois,
Hey, Anna.
welcome.
Great Lakes.
It's getting cold, all right.
I
Washington.
know.
Washington.
Iowa.
Colorado.
Awesome.
All right.
Colorado. Yes, yes. So we are we're all over the US, huh?
Yeah.
All right. I'd love to see more faces. You know, Angelina, she trains the best when she see your face.
Yes, definitely. This is an interactive workshop.
Interaction.
There will be some Q&A, and if I could see your faces, that you're understanding the information, it's, you're getting the information before I move on to the next slide. That really helps me. So if you guys can turn on your cameras, I really appreciate that, because it just makes it a bit easier for me to stay in tune and just making sure that everyone's getting the information and understanding it. So thank you.
My camera doesn't work, so
Okay, no worries. But those that can, I'd really appreciate it. I'm in Southern California. It is a desert over here still. It will be probably into October. We're used to in the heat over here. We have not had rain in a long time, so I would love some rain that you guys are getting.
Well, you can have it. I'm a little over it right now, Angelina. So okay, so tonight we are doing the life side, ladies and gentlemen. So get your notebooks out again, get your ears ready to learn. That would be pretty awesome and very engaging. Last class was really fired up.
Great.
So how many in our last minute, how many has repeated this workshop, the life side, more than twice?
Oh.
Okay. All right. Okay, I see a few hands.
Yeah, that's the way to do it. You gotta just watch it over and over.
Over and over, right? Okay. Thank you guys for responding. Well, we start on time and we like to end on time because time is precious. So without further ado, again, I'm looking forward to more cameras being open, but we're going to pass the Zoom over to Miss Angelina, who's going to be our facilitator tonight. So Miss Angelina, the Zoom is yours. I'll just watch to see whose camera's on.
Yes, thank you. Okay, well, welcome. Good evening, everybody. It is 6 p.m. over here in Southern California, and today we are going over workshop 1, which is going to cover life insurance. So our license prep workshops, there's 3 sessions that are going to repeat a total of 5 throughout the week. So we do workshop 1 for 2 days, today and tomorrow morning. That'll cover everything life insurance. And then the second workshop 2 is going to cover annuities, disability plans, and government plans like Medi-Cal, Medicare also. And so you'll definitely want to make sure that you attend those. Those will happen 2 sessions this week as well. And then the third session we cover is every Sunday afternoon, 3 p.m. Pacific time, which is our cram question session. And that's where we're going to simulate the actual exam so that you'll just hear question, answer, question, answer, question, answer to just make sure that you are retaining the information and you're practicing, just you're timing yourself as well, because you want to make sure that you finish the exam on the allotted time. So if you haven't attended our cram session, then definitely block that time off on Sunday afternoon. So let's go ahead and get started into our workshop 1. Let me just set up my screen real quick so that I could see you all. And all right, now I have you all in my eyesight. Okay, so today's workshop, life insurance. And so we're gonna cover the concepts that you'll need to understand for passing your exam and being a good agent. Now, as we started off, sharing that we have a lot of people online from all over the country, all different states. And so the information that we're gonna share today, it's going to be pretty much general, that's going to apply to all states, but each state will vary with a couple specifics, rules that you'll need to know for your state. So definitely make sure that you're still doing your own online pre-licensing if you have purchased the course of Exam Effects, AD Banker, Excel, just so that you can be reviewing your actual state laws and regulations. But those are minor. Everything you're going to learn in our 2 workshops are going to cover the majority of your life license exam. So first off, a disclaimer, the information in our workshop should definitely not be interpreted as accounting, investment, legal, or tax advice, nor is there any offer to sell or a solicitation to buy any security, insurance, or any other financial product. Now, our workshop is for educational purposes only. We do not guarantee that you will pass your exam with our workshops. It doesn't replace also any pre-licensing requirements in your specific states. Some states, like in California, we need to do 52 hours of certification licensing before we go take our exam. Other states require less or 0 hours of pre-licensing. So make sure that you know exactly what your specific state requires for you to get your license. Our workshops are just meant to be a supplement to assist you in studying. And I definitely recommend taking these workshops multiple times, because as you're reading all the content in your pre-licensing course, these workshops will just help you understand the information better. They're visuals, we're doing question and answers, that's interactive, and it'll just help better, understand the terminology and the definitions and the concepts that you're reading in your pre-licensing class. And of course, to help us preserve the integrity and context of this information, please don't take any photos, videos, or record the workshop. Sometimes when that happens, we're just taking a snippet of information without the explanation before and the explanation after. And we're just leading people to kind of make up their own assumption of what that snippet means. And we don't want to lead, we don't want to add to any misinformation. Just invite them to the workshops. They're free. You can take them as many times as you want, and they're ongoing. So let's go ahead and get started with what you need to know before you get licensed. Okay? Every day we're flooded with information. Many offer financial advice, but are unlicensed or even without industry experience. And that's a big part of that is because of social media. A lot of people see what other people are talking about, what's getting likes, what's getting follows, and they're repeating it. Maybe not even knowing if they're repeating outdated information or misinformation. And so you want to make sure that you are getting your information from trusted licensed professionals like ourselves who are teaching this information to help you pass your test. The benefits of having a license is that it's awarded by a governmental licensing agency. It gives you legal authority to work in a profession. And in some states, it requires meeting predetermined criteria, such as passing a state administered exam. It is a privilege to be licensed. And so being a licensed agent comes with great reward and responsibility. So let's take a look at our Power4 platform that you guys are all a part of. Once we're licensed and appointed, we're able to offer all of these products and services. So if you're new to the game, life insurance license is not just to sell life insurance or death insurance. That's just one of many solutions that you can offer to families. What about people that are leaving their workplace and they need to move over their retirement plans? With that same one license, you can help them with a fixed or indexed annuity, which is an individual retirement plan to help them continue to plan and prepare for their future. Medicare supplements is another solution that you can offer with your license, and even long term care insurance. So we're not just talking about what if I die, but what if I get ill? What if I need care? How do I prepare for that? Who covers that cost? That is another solution that you can talk to people. And so I love that there's many ways that we can use this license, and you can get paid many different times on different solutions that a family needs. Final expense insurance is also called funeral insurance. And so maybe somebody doesn't qualify for life insurance. Maybe due to their health or maybe due to their age, it's far too expensive for them. But they just want something minimal to cover the cost of a burial so they don't leave a debt or a financial burden to their family. That's something you can help them with the same license. And then we have really great referral partners that can offer other types of insurances as well, like property and casualty, home, auto, pet. And those are by referrals. So you don't even need to do the quotes for those, do the policies for those. We just refer them to our partners and you earn a referral fee. So many ways to use your license. You pick and choose what you feel comfortable with, what you want to start talking to people with. And I love this because in an industry where there's so many different options, you can be able to talk to people on what they need right now. Maybe you can't come in through the front door talking about life insurance, but you can come in through the kitchen door or the side door talking about long-term care, talking about their rollover from their workplace, talking about funeral planning. And so, it's exciting to learn all the different ways you can use your license. And when you're properly licensed, we're compensated by providing proper solutions and strategies. So here's an example. When you help somebody with a proper protection, let's say life insurance, and assuming, in the first year they pay $3,000 of premium, so about $250, $300 a month for a life insurance policy. When you first come in, you're a training associate because you just got your license. You may not know exactly how to explain a plan, answer questions, illustrate a quote. So you have a trainer helping you. But as a training associate, we're going to start you off at a 25% contract. So for that one solution, which typically would take maybe 1 to 2 hours, you earn $750 right there. I think that's great extra income for just learning earning while you're learning. And then in about 30 days, about a month, we want to help you become a associate. So you're no longer technically a training associate, but now you understand more or less how to use your license, how to talk to people, answer their questions. And so when you help a family with the same plan, your commission at 35% is $1,000, $1,050. So really great for just 1 to 2 hours of work. In about 3 months, our goal is to help you become a marketing director with our firm. And so that means you also get a raise and a higher contract at 50%. So now when you help a family with that same plan, you earn $1,500. Imagine if you just help one family a week. That would replace most people's full-time incomes. And then overall, we want to help you build a business here, build your own agency. And so within 90 days, you could build yourself up to have a 65% contract. And now for the same plan, that would be a commission of $1,950. So how would you feel with an increase in your cash flow? And you decide how quickly you want to start making more money. You can do that through our platform and our system. So we commonly get asked if we need to be licensed to recruit, because you were all recruited here and you saw an opportunity. Now you're getting licensed, and some people ask, do I have to wait till I'm licensed to start building my agency, start building a team of people that I want to work with me? You don't. So you can share about our opportunity when your AMA, your associate membership agreement with our organization, has been approved, and you get your code number. But when you want to talk about specific companies and products, that's when you need a license. So let's talk about that. You need to understand the guidelines of when and who you can prospect based on where you're licensed, so you don't violate any state rules. Okay, so as soon as you all get licensed, you will be considered a resident licensed agent. Resident means that you hold a residence or primary place of business in a specific state. So I live in California and I got licensed. I work in California. I got licensed in California. So I'm a resident California agent. But if you want to share about life insurance products or any of those products that we saw on that wheel with somebody outside of the state where you're licensed, then you must obtain a non-resident license first. But the great news is you don't have to take the test again. You only have to pass it one time. And to get a non-resident license, let's say you have a family member that lives in Texas or another state where you're not a resident agent. All you have to do is go to their Department of Insurance website, fill out the application so that you can let them know you've already done all the predetermined requirements to get licensed, you passed the exam, and you just pay their state fee to be a non-resident license in that state, and then you could talk to your clients in that area. So let's do a question answer. You have your life and health license for California, which is where you have your primary residence. Your friend John, who lives in Utah, is coming to San Francisco to visit for a week. Are you eligible to speak and sell California life and health products to him? What do you guys say? Go ahead and unmute yourself or nod your head.
Yes.
Okay, I hear both
Yes, ma'am. No.
Okay, and I hear some no's.
Yes.
Okay.
No.
Okay.
Yes.
Thank you.
No.
Okay, thank you.
Yes.
And then this helps too. This is why it helps if you guys have your cameras on. So I could see you nodding, shaking your head as we go along with the question. So if you're able to have your camera on, that helps me too, just so I know you're getting the information that we're sharing. Okay, so the answer is yes.
Yes.
You can, because John is now on your turf where you are licensed. So that means you can talk about California Life and Health, and he can even buy it. Even though his address on the application is going to say Utah, that's okay. He's in California. He wants life insurance. You're his friend. He wants to buy it from you. That's okay. Now, let's say you only have your life and health license for California, which is where you have your primary residence, and you are at home on a video call with your friend John, who is at his home in Utah. Can you speak to John about any life and health products? What do you say?
No.
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 Okay, so I hear predominantly no's, and the answer is no, because John is in his state. So if you just have to remember, where is the client physically? Even though this is the video call, if you know ahead of time, John wants to talk to you about protecting his family, talk about some of the solutions that, you can help him with, then you need to make sure that you go to the Department of Insurance for Utah, apply for a non-resident license prior to your video call, so that you are authorized to talk about Utah's life and health products. Okay, so go ahead and mute yourselves, you guys, until we get to the next questions, just so there's not too much background noise. But some other terms that you're going to see on the exam is we saw resident and non-resident, and now we're going to talk about agent or producer. That's you. You're both of those. And so when you're licensed, you're commonly called an agent or producer, so don't get confused on the question. But also, you as an agent, you're either captive or non-captive, okay? Captive means that you're a career agent for one insurance company that sells only that company's insurance policies. And non-captive are independent agents that work for themselves and sell the insurance products of multiple companies. Okay, so you can represent many companies that will appoint them. So here with WFG, which one do you guys think we are? We are non-captive. Okay, when I see this slide, everybody, I think of Honda and CarMax. Okay, you go to a Honda dealership, they only sell Honda cars. So you might be, wanting some other features that you saw in a Tesla or some other car. They don't sell Teslas there. They only sell Hondas. They only sell one company's cars. You go to CarMax and you can tell them exactly what features and benefits you want, and they will pick the right plan that has everything that you need. So I feel very proud to be part of this organization and to be able to represent multiple companies, because it's not one size fits all. Some people might need this and it may not fit someone else, and we can find a plan for everybody. Okay, the next term you're going to need to know for your exam is fiduciary. And this is you. When you're a licensed agent, you are considered a fiduciary. You're a person in a position of trust. You have a financial responsibility towards your clients. Okay? As a fiduciary, it's your job to prioritize the best coverage for your client, what is suitable for them, and what's affordable, finding the right policy that the client can fund for the long term. So you want to make sure you do it right and you do it with pride. One important bullet point you want to understand about a fiduciary is that you are never allowed to commingle funds with your client's accounts, okay? I don't care if it's your sister, if it's your cousin, if it's your best friend. Let's say, it's August 10th and they are ready to buy a plan. You're ready to help them with a plan, but they just can't have that first draft from their bank account until the end of the month. And you offer, well, let's go ahead and apply right now, and we'll put my bank account just for the first draft, and then once it's issued, we'll switch it back to your bank account so it's ready to go. But that way we can get it in now, and we can get the process started. Okay, that's a big no-no, because you've just commingled your funds with your client's funds in one account. Okay, so there is a reason why this is a bullet point under this slide, so make sure that you remember that on the test, because this is a problem in the financial industry, and we want to make sure that you are licensed properly and doing it right and with pride for your clients. Okay, so next we're going to go over general insurance terms and topics. So first off, what is insurance? It's a transfer of risk from one party to another through a legal contract. It provides a guarantee of compensation for a specified loss, damage, illness, or death. So what are most common things that you insure? We insure a car. I paid this much in case my car is in an accident, it's totaled, and I don't have to pay this much. I transfer that risk to the insurance company. Same thing with my phone. I pay about $12 a month so that if I drop it, lose it, it gets stolen, I don't pay about $1,000 for a new phone. I transfer that risk and that financial liability to the insurance company. We do that for our health insurance, for our home, for our vacations, pet insurance. This is how we protect our responsibilities and our assets, just like you have purchased a warranty on something. Now, let's understand how insurance companies calculate their rates. How is it that, I buy $500,000 of life insurance and Joaquin buys $500,000 of life insurance, but the cost is very different? It's going to vary on a lot of different factors. And so insurance is based on the sharing of risk among a large pool of people. That's called the law of large numbers. The larger the number of people, the more predictable the losses are. And insurance companies will use this data to calculate the rates. So they're going to look at, statistically, people that have diabetes and what's their average lifespan or their health in terms of, versus people that don't. What about people that have been taking metformin for the past 20 years versus people who haven't? What complications have they had? That's gonna affect, the insurance costs for this group of people as this group of people. Or somebody who's had people, the statistics of people that have had strokes or heart attacks versus people who have not, or even the statistics of people who have DUIs or speeding tickets versus people who have not. They're going to look at all of those statistics, all of those numbers of these groups of people to basically calculate how much they're going to charge for somebody who has this versus somebody who doesn't. Okay, and so that's going to be when you're looking at the questions, you'll want to remember that the answer is going to be about how do they calculate the cost, the rates of insurance is going to be the law of large numbers, the sharing of risk among a large group of people. So speaking of ratings, some of the companies that rate life insurance companies are these right here: AM Best, Fitch Ratings, Standard & Poor's, Moody's. What you really need to understand is they are rating the insurance company's financial strength. So an insurer's strength can be evaluated by looking at the company's reserves and liquidity. What is their ability to pay out these claims? So if they have so many clients with so many that have so much amount of insurance that they bought, and if there was, a disaster or some sort, and they have to pay out these claims, what is the strength, the financial strength that they're able to do that? And so if those numbers don't match up, then their ratings from A, B, C, D are going to start to go down. So these are companies right here: AM Best, Fitch Ratings, Standard & Poor's, Moody's. They're kind of holding our insurance companies accountable, by posting, just like you went to a restaurant and they post their A, B, C, D rating on the window. Same here. With all of the companies we represent, they have the same type of ratings on the front page of their brochures. So let's talk about the different types of insurance companies. There's two types. There's mutual companies and there's stock companies. So mutual companies, they're owned by the policyholders, kind of like a co-op. They grow their financial strength due to the amount of clients that they're getting. So they're and the premiums that they're getting from the policyholders. So the dividends are paid back out to the policyholders, usually in the form of interest rates on the cash value. The profits are paid back out to the policyholders. And so you might not see on the test, it's a mutual company. They might be talking about a participating company. That would be another word for them. So just think about mutual is together, participating means we're together, participating. So you want to kind of think of that as just kind of put those together when you're thinking of that type of insurance company. A stock company is where they are bringing in shareholders, investors, stockholders. So the dividends and profits are going to get paid back to those investors, the stockholders. And so another word for this type of insurance company is called a non-participating company. Okay, so the definition of an insurer is the company who issues the insurance policy. And an insurance policy is the written contract in which the insurance is set forth. So one insurance company can offer different types of policies depending on the suitability of the client, and different insurance companies, can offer the same types of policies. So just because a company is an insurance company doesn't mean that they offer all the different types of insurances. Some insurance companies might just offer one type of insurance. Other insurance companies might offer 5 different types of insurance plans or products. Okay, also for the test, you're going to come across this. Most people think of a person as a human being, but in this world, a person can be an entity. So don't get confused when you're reading the question and you're not seeing a name like Martha or John. The beneficiary, the owner might be a corporation, might be an organization. a trust, or even a business, and it's a partnership. Okay, so when you read the question, because on the life and health insurance state exam, they have attorneys specifically writing these questions to try to confuse you. And so you want to make sure that when you read this, you don't stay too confused, because you understand a person isn't necessarily a human being. It could be one of these entities. Okay, so let's talk about the different types of life insurance. There are two types of life insurance today. There is term and there is permanent. Okay, permanent coverage is also broken down with different options for their cash value. And so we're going to break down the different types so that you understand the purpose of each of them. No matter what type of insurance it is that we're going to cover, they all fulfill a purpose and a need. So we're going to cover first term insurance. Okay, term is just like the word says, it's for term of time. So instead of buying a life insurance policy that covers you for your entire life, this one is going to cover you for a specific term, typically 10, 20, 30 years. So there's about 3 different types of term insurances. The first one is called decreasing term, or also when you see the word decreasing, I want you to immediately think of mortgage. Decreasing means equals mortgage, mortgage equals decreasing. And so here you'll see it's a 20-year term. So you see the lifespan of this policy is from year 1 to year 20. And in year 1, you start off with $200,000 of life insurance. And every year that $200,000 goes down. So your insurance is decreasing. So can you imagine why it's typically called mortgage insurance? Because maybe you buy a house and you just owe only $200,000. As you're making your mortgage payment, now you maybe only owe $195,000. So you don't need $200,000 coverage anymore. Next, maybe a couple of years later, you only owe $185,000. And then as you're paying off your mortgage, you owe less and less. So the coverage you need to cover the outstanding balance is less and less. That's why decreasing term is typically used for mortgages. Next, we have level term, where you can see from year 1 to year 20. You always have the same amount of life insurance, $200,000. Your death benefit is level and the premium is level, because what they've done is they pretty much calculated from let's say age 20, how much is $200,000 for a 20-year-old? How much is $200,000 for a 21-year-old? How much is $200,000 for a 22-year-old? And they're going to go across the 20 years, divide it up, and this is your fixed premium. It's going to stay the same for the entirety of the 20 years. And then we have the third type, which is called increasing term, which you'll see from year 1 to year 20. You start off with $200,000, and then every year your coverage increases a bit until the 20th year. You now are covered with $300,000. So your death benefit is increasing, but because you're buying more insurance every year, your premium is increasing too. Okay? All right. So term is the simplest type of insurance. Like renting an apartment, the insurance company will pay the death benefit should anything happen within the length of that term. So you have different ways that you can pay for term insurance. The first one is annual renewable term, which, let me tell you guys, as you start to see all the different types of insurances and all the different types of plans, almost always the name is going to tell you exactly what it does. So this one is called annual renewable term. So you're going to renew this term every year. So that means the premium goes up every year. So you're basically only locking in the cost for 1 year, and then you need to renew it again. And you're renewing it at 1 year older. So if you bought this at 20 years old, it's going to cost less at 20 years old than when you're 21, because you're 1 year older. You're 1 year closer to passing away, because eventually we're all going to pass away. And the closer you get, the more the cost of insurance is. So let's say you're like, I don't want to pay a different amount every year. Can I lock in my rate? So then you might want to 5-year level term or 10-year or 20-year level term, which basically means you're locking in the rate for those 5 years. And then when that term ends, that's when you renew it. Because let's say after 5 years, you realize, well, I'm barely 25 years old and I have a family now. I have another child now. We just bought a home. I still need protection. So I want to continue to have life insurance. Let's go ahead and renew it for another couple years. And in that case, you might consider maybe renewing it for a longer term of time so you don't risk not being able to renew it again should anything change with your health or your finances. So let's take a look at the advantages and disadvantages of term insurance. The first advantage is it's low cost. It's relatively inexpensive because you're not buying life insurance until you're age 100. You're buying just a few years of life insurance. So it's going to cost less than a permanent plan. And you cover a liability for a specific amount of time, whether it's you just want to cover your mortgage, your home while you have a mortgage, so that if anything were to happen to you, the mortgage can get paid off. Or if maybe you just want to cover, for a amount of time while you have minor children, whatever it might be, or while, whatever your reason might be, that's why maybe you just buy a term insurance. Now, the disadvantage is that you're only insurable for a specified amount of time. And the policy will lapse if the premium payment is missed. Term insurance is just like car insurance. If you miss making your car insurance payment, you no longer have coverage. You need to renew your policy. And we know many times that rate is probably going to go up because you would have locked in a rate for a while. So there's a risk that you can lose your coverage if you don't make your payment. Premiums are wasted if you don't die within the term. Right now, I think it's like 90% of people will outlive their term. And so, most people that have a term, this is the risk. But at least, term insurance is on the advantage, relatively inexpensive. And if that's what somebody can afford for right now and be able to have a couple $100,000 of coverage, then it is the best plan for them at the moment. But you want to make sure that you have a plan in case you outlive this policy and you still want to continue to have coverage. Becoming uninsurable forces you to renew at higher rates. So this is something you're not guaranteed to be able to renew your plan when your term ends. What if at 20 years old, I bought a 20-year term and now I'm 40 years old, I'm still alive, I have minor children, I have a home to protect, I still want life insurance, but my health has changed and I may not be able to qualify for a new plan. Then I'm forced, if I have the option, to keep the plan I have and pay whatever rate they choose to increase it to. And your policy cannot be renewed beyond the maximum age. So I can't just buy a 20-year term after 20-year term thinking I'm going to cover myself to age 100. No. After a while, they're going to cut you off, and it's usually, earlier than later, and then you will find yourself still living and still wanting maybe to leave something to a spouse or your children, your grandchildren, but you may not be able to qualify for that. Okay, so let's ask the question. Mr. X purchased a home with a 30-year mortgage. He is concerned that if he prematurely dies, the mortgage will not be paid. So which policy best suits him? The annual renewable term, the 30-year decreasing term, 30-year increasing term, or 30-year level term? What do you guys think?
30-year B.
Okay. So I heard two. I heard decreasing and increasing. The answer is decreasing. So remember, if you see the word mortgage, you immediately go look for the word decreasing. And I'm telling you this for sake of time because there will be some questions. You're going to sit there for a couple of extra minutes trying to figure out what are they asking? What's the answer? So to make it easier on some of these other questions, if you see the word decreasing, go and look for the word mortgage and vice versa. Okay. So let's talk about permanent insurance now. So if term insurance is like renting an apartment, permanent insurance is like owning a home. There is cash value, equity associated with the account that can potentially generate interest to help pay for the higher cost of insurance as you get older. So when you look at this chart, this green box right here, it represents the premium the client is paying. You can see they're paying the same amount for the entirety of the plan. And this is a permanent plan, so this is going to be, they're paying the same until age 100. This purple line represents what is the cost of insurance. So the green line, the green box and green line is how much the client is paying throughout the life of the policy. And the cost of insurance, it's lower than the green line in the early years. Absolutely. So the way permanent policies are designed is that you overpay your cost of insurance in the early years to help pay for the cost of insurance in the later years. So that when I get to my 60s, I don't get an invoice saying, okay, now that you're older, you need to start paying more. And I'm like, well, I just submitted my retirement paperwork. I'm not making an income anymore. You don't have to worry about that happening, because what we're doing is we are overpaying in the early years. It's designed so when they tell you, here's your quote, this is how much you have to pay or we recommend you pay, it's averaging the cost to provide you the guarantee of giving you life insurance now and later in life. So let's take a look at the different types of permanent life insurance policies. Okay, all three of these cover you to age 100 and beyond. Nowadays, when I first got my license, life insurance covered us to age 100. Now, life insurance covers us to age 120. So I know many of you say, I don't want to live that long, but statistically, based on mortality and morbidity tables, we are. With modern medicine, they're keeping us alive longer. And so you need to make sure that you're talking to families about having proper protection for that. So let's talk about these three. The first one we're going to talk about right now is whole life insurance. Okay, I kind of look at this when I see this chart right here. This reminds me kind of the evolution of life insurance, to be honest, because whole life was one of the first types of life insurance. It's still out on the market. That's why you're going to see it on your exam. But it is one of the oldest types of life insurance. Newer types have evolved and come out. And so, but you still need to know about everything that's out there. So let's look at whole life. This is a policy you keep for your whole life, just like all the other ones. Just because this one is called whole life, they just happen to, grab the name. They all are for your whole life. That's why we call them permanent insurance. This type of permanent insurance, whole life insurance, part of your premium purchases insurance, which can be sold back to the life insurance company, creating a cash value. So when we look at our chart, okay, all life insurance, whether it's term or permanent, is going to have this design. The cost of insurance always goes up, okay? The cost of insurance is always, every year you get older, the cost of insurance is going to go up. The premium, okay, that's the green box. The premium is what the client has to pay every month. And so the premium in whole life is going to be fixed. So basically, what is cost of insurance? I'm 46, and let's say Celia is 65. We're both buying $500,000 of life insurance. The cost is going to be different for both of us. Why? Because we're different ages. So even though, we might even pay the same amount, we might both put $500 a month into our policy. The cost of our insurance is going to cost different because we're different ages and we are different health ratings. So you need to understand the difference. The premium is what the client pays. That's the green box. And remember, they're going to be recommended to pay more than what the cost is. We overpay in the early years so that there's extra money to pay for the later years when the cost of insurance is higher than what our monthly premium has been our entire life. And now with permanent insurance, as that money's sitting there, okay, that overpayment, they're going to put it to work. They're going to give us some interest rate for giving that money in advance. And so you may have additional cash value that will help to pay for the cost of insurance later, or may be extra cash that you can take out of the policy. So the advantages of a whole life policy is you get that guaranteed interest rate on your cash value. Your money's not just sitting there in a box, not growing, not doing anything. They're actually going to give you some interest rate on that cash while it's in there. You have the option to design how you want to pay your policy. Do you want to pay it off in 10 years, 20 years, maybe just pay to age 65? But you have to decide that while you are in the application process prior to them issuing the policy. Then you cannot make any changes afterwards. It's a permanent policy designed to last your entire life. Now, the disadvantages is that the guaranteed interest rate does tend to be conservative. So there may not be much cash value growth. Also, the premium is fixed. Okay, and so as we all know in life, that our finances can go up and down, our responsibilities can go up and down, and maybe when I bought this plan, I had a good job, was making good income, and a couple of years down the road, that might change. And maybe now I can't afford the same premium, the same policy. Can I make adjustments to my premium? Not with a whole life policy. The premium is fixed. So now you run the risk that you won't be able to pay this and you lose coverage. The death benefit is fixed also. So, I don't know how many of you, like myself, I bought my first life insurance when I was 23 years old. I bought $100,000 life insurance. That's all I needed at the time. But now I'm 46 and I have a family. We have a mortgage. I need more insurance. My responsibilities grew. So I need my death benefit to grow too. I wouldn't be able to add more insurance to this plan if I wanted to be covered with more insurance. And really important, accessing the cash value in a whole life policy eliminates the guarantees that they offer you. We're going to talk about that in some of the next slides. So here's a question. An accountant has income potential for 20 years and is looking for a permanent insurance. Which policy best suits him? The 20-year decreasing term, 20-year inflation term, 20-year increasing term, or the 20-year pay life?
D.
Pay
D.
As in
D as in cat.
Okay. So I hear predominantly D, which is correct. Even though I have not yet said this term, 20-year pay life, if you've never heard of the answer that you see on the screen, that's okay. You're going to have to use process of elimination. We know in the question he's looking for a permanent insurance. So we know that it is not A, B, or C, which are term policies. So if you're not sure what the heck is a 20-year pay life, doesn't matter. You know for sure it's not any of the other three. You're going to go ahead and select D. So with whole life insurance, there's 3 types of non-forfeiture options. Basically, you're saying, I bought this policy, and a couple years down the road, I realize I either can't afford it, I can't keep it, I don't want it. So you have a couple options. The first one is called surrender for cash. Okay, remember what I told you earlier? The names of everything pretty much tells you what it does. So surrender for cash basically means that you can give up the policy, you no longer want to make premium anymore, you no longer want coverage, you are surrendering the policy, and you would like to be able to take out whatever cash value you qualify for. So here, the client opens this permanent policy. After 5 years, the client needs to surrender the policy. How much is a client surrender value? What do you say?
B.
It's B.
B as in boy.
as in boy.
Thank you. So I hear B, yes. After 5 years, the chart will show them that they can close the policy and they will be able to receive a check from their cash value of $4,588. Now, let me tell you, and you're going to learn this too, this client probably has about $15,000 in the cash value. But because he is breaking a contract, This is a life insurance policy. The insurance company offered guarantees to provide you life insurance for the rest of your life. And the client is breaking this policy saying that I no longer want to pay for this coverage. I want to cancel it. So there's going to be a surrender fee. And this is going to be his surrender value. This is what he'll be able to receive from the cash value that he has in there for leaving this policy or this contract early. Now, the second option, non-forfeiture option, is called paid up insurance. So this is where you use existing cash value, because remember, we overpaid in the early years. So there's cash value in there. Part of that cash value went to go pay for the cost of insurance that year that they were covered. And then the other half went into the cash value, the savings portion of the policy. And so in this option, we're going to use the cash value to purchase a smaller but fully paid up whole life policy. That's why it's called paid up permanent. So I still want permanent insurance, but I can't afford to have the amount that I had before. So with my cash value, how much permanent insurance can I have? So if the death benefit was a $100,000 policy, like my first policy, and the client decides to use the paid up permanent insurance option at year 20, what is the new death benefit and how long will it last? What do you say?
C.
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 Okay, I hear
C.
C and
D.
D. Okay, so let's take a look at this. At year 20, he's basically saying, I want to surrender this policy and I want to use the paid up insurance. So at year 20, they're saying with the cash value that you have in here, that's enough money to buy you $63,000 and 100, $63,000. But remember, you're buying a permanent, a fully paid up. The option says paid up permanent. So because it's a permanent policy, it's going to cover you to age 100. Okay?
That's D. That's D.
Okay. Great. And then the third option is extended level term insurance. So this is where you're going to use the existing cash value again to purchase a level term equivalent to the face amount that you had. So right here, the client is 50 years old and stops paying at year 10. The policy automatically defaults to an extended level term insurance. So at what age will his term expire?
C.
C.
Okay. Okay, so I hear C. So he has a
C.
permanent insurance, remember, for $100,000. Okay, and at year 10, he wants to stop. So the chart says at year 10, you can continue to have 100,000 because they're extending the coverage, but not till age 100 anymore. They're going to give him 100,000 for a few more years. How many more years? 18 years and 17 days. So if he's 50 years old, in 18 years, he'll be 68 years old and 17 days. So that's why it's C. Okay? So he continues to have his 100,000, but now not until age 100. He's going to just, how many more years can it buy him if he uses the cash value that's in there? So those are the three non-forfeiture options. Only whole life has these. You only need to memorize this for the exam, but just keep it very simple. The basic thing I could tell you is just remember, the name of each one tells you what it does. So you're not going to have this chart in front of you. You're probably not going to remember any of the things that I talked to you about, but just know, just take your time and read the options. It'll tell you what they do. Okay, so let's move on. Whole life over the years evolved into, well, didn't evolve, but a new plan, a new product came out onto the insurance market because the economy changed. The financial industry changed. People's needs changed. And so they created a new insurance plan to meet those needs. And that was the universal life. And so it's a much newer policy than the whole life. And it can also be called adjustable. Okay. So I always tell people, think about universal life. This is the way I learned this. Okay. In 2003, that was a long time ago. When you see the word universal life, I want you, for those that are over 40, over 40, I want you to think about Mr. Universe. Mr. Universe flexes, okay? He's flexible. He's a bodybuilder. So when you see universal life, I want you to think of flexible options, adjustable options, okay? That's what helped me. So I'm hoping that helps you. So now, it's similar to whole life as it is a permanent insurance for your entire life. However, it has flexible premium with minimums and maximums and a flexible death benefit. So you're going to be asked questions. Which of these policies allows you to adjust the death benefit, has flexible premium? And I want you to think of Mr. Universe flexes. Okay, so here you go. You have the cost of insurance. Every type of life insurance, the cost of insurance always goes up. The green box is the premium. How much is the client paying into the policy? You're always going to overpay in the early years so that there's enough money there to pay for the later years. Now, with universal life, though, you see how the premium goes up and down? You could pay more or you could pay less. There's a maximum of amount, how much you could dump into this policy, and there's a minimum amount of how much you could pay into this policy. I like that because our finances sometimes always change. And maybe you get a bonus. Maybe they cut your hours. Maybe you're in construction where, it's a down season. You want a policy that can adjust with your lifestyle. This could be that plan. And remember with the cash value, since we overpaid in the early years, that money's sitting there for later on. They're going to give you interest rate for leaving that money in this plan. They're going to go make money on your money. And so that allows your cash value to grow more so that there's more money to cover the cost of insurance. And there's more money that you may be able to access for cash value. And I like that also because maybe I don't pay my premium for the entire life of this policy. Maybe I stop for a few years because I become unemployed. At least I know that cash value growth added some extra money to my policy to make sure there's enough money in the policy to cover the cost of insurance. So the advantages of universal life is that it's flexible premium. And it is a flexible death benefit, okay? So as your needs change, you can make changes to this policy. The policy and payment can be designed during the life of the contract. So you can make changes to this plan. And it's a permanent policy designed to last your entire life. Now, not just to age 100, you can get a universal life policy to age 120 years old. And you have access to the cash value. The disadvantages is that there could be guaranteed interest rates that can tend to be conservative, meaning just low interest rate. And you might be able to find higher interest rate with other plans. And very important, because this is a flexible plan and you have the option to lower your death benefit lower your premium, your monthly payment, or maybe not even make a payment for a couple months or two. Then you run the risk that you might need to pay additional funds, additional policy premiums later in life because there wasn't enough money that this policy needed to give you the guarantees that the life insurance company offered you. So you want to be careful with taking advantage of those flexible premiums. Okay, so next we're going to look at Index Universal Life, which is a cousin of Universal Life. Now I can say it's a new plan that has evolved over time. And so Index Universal Life, or might even be called Equity Universal Life, has a flexibility because it says universal. So you see universal, you think of Mr. Universe. But a cash value that accrues crediting interest based on the market index. So what that means is when you see the word index funds, just index, basically what they're saying is that the plan is going to credit you what the interest that the market is doing. So they are not taking your money and investing it in the market. Your money stays safe in this plan, but they're going to mirror whatever the S&P 500 or whatever index fund that you're in, whatever the market is doing, if it did 5%, they're going to credit you 5%. If it did 10%, they're going to credit you 10%. So you might see the word credit, you might see the word mirror, and what they're referring to is index funds. It's one of the safest ways to get that market growth without the market risk, because they're not taking your money out of this plan and investing it in the market. They are crediting you what the interest is doing. Okay, so here we have the cost of insurance always goes up. The green box is the premium that the client pays. They can pay more, they can pay less, because it's a universal, it's flexible, and you're going to get interest, credited towards the cash that's in the cash value. So that could be an extra 5% interest, an extra 10%. It could be an extra 25% interest, depending on the index funds you use. That means there's more money to pay for cost of insurance later, which might mean you don't have to pay so much premium for later on, and it means that there'll be additional cash that you can pull out. So the advantages are that the crediting interest ability to rise with market gains, meaning you get that market growth without the market loss. You have the flexible premium because it's universal, flexible death benefit because it's a universal life policy. The policy and payment can be designed so you can make changes to this plan, and it's a permanent policy designed to last your entire life. And you have access to the cash value. Now, an underfunded policy, this again is the same disadvantage. Because you have the flexibility to lower your payment or not make a payment, you run the risk that there's not enough money in this policy for it to be designed the way it was designed to give you the benefits and features of whether it's the riders, the life insurance, the cash value for this policy to stay alive. Now, let's talk about another type of life insurance. It's called a variable life. You'll definitely see this on your exam. And the main difference with this is just the cash value growth. The cash value is in a separate account. Okay, they did go and invest your cash value with that money you overpaid in the early years. They are investing it in stocks, bonds, and other investment vehicles. So this separate account is regulated as a mutual fund by the SEC. And you do have greater growth potential, but that also means you have greater risk potential. And the cash value and your death benefit can change daily based on the investment performance. And there is no guarantee regarding the cash value because obviously you're variable, you're in the market. And so agents that want to sell a variable life insurance policy, they require 2 licenses, not just the life insurance license, but also securities license. And so variable life, there's also variable universal life, which means what? All that was added was the word universal. So you have some flexible options like flexible premium. Okay, so let's answer a question. Out of these types of life insurance policies, which combines the savings component with the flexible premium option?
A.
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 Why is it
Mr.
A?
Universe.
Mr. Universe, you see
Flexible.
You see flexible, you see universal. They go hand in hand. Awesome. You make me so proud. Okay, let's go to the next thing. Let's talk about designing the policies. Okay, life insurance can have different designs based on who is the owner, the insured, and the purpose. So even though, let's say parents right here, parents don't rely financially on their minor children. A parent may want to buy a life insurance policy for their child to lock in their insurability. So right here, the mother buys a life insurance policy. She is the owner, but she is not the insured. So does it matter what health conditions she has? Does it matter if she's had a stroke, if she's recovering from cancer, anything like that? No, because her life is not the life that is insured. The child's life is insured. She's just the owner. She pays for the policy. And 2 very good reasons to buy life insurance policy on a juvenile would be number one, to lock in their insurability. You know, right now the child is the healthiest they will ever be. And so you want to make sure as they get older, you know, if they have, you know, they have the risk of, you know, getting injured or developing a disease or becoming ill. And then later in life, when they start a family, they might want to buy some life insurance and they don't qualify anymore. That would be a reason to buy it while they're young. It's for their entire life, and they don't have to qualify for it later on because they already own it. Okay. Another reason would be to use the cash value as a means for planning for the future. You know, being able to put money in there to save, not just to lock in the insurability, but to have money to take out for college or to start a business or, you know, to be able to transfer the policy to the child when they're an adult and now they already have some retirement savings built up for them for the future. Now, there are two kinds of policies that can be more affordable for families or used for estate planning. And so the first one would be a joint life or first to die. So you may get asked about this on your exam. And so this would be where both the husband and the wife are covered on the policy. But the death benefit won't be paid out, will be paid out when the first person passes away. So in this case, let's say the top example, the wife passed away, the death benefit is paid out to the husband, a death benefit has been paid out, so now this policy is done. He no longer has coverage. He had coverage while they were both alive. Now this policy has ended, it's closed, and now he might have minor children. He might still be in his 40s or 50s. He may still want some life insurance, and now he doesn't have any. So good news is he has the death benefit to cover and replace her income, cover some financial needs. Bad news is, though, if he wants to have some life insurance, now he has to apply for another life insurance of his own. And maybe now at an older age, he runs the risk it might be too expensive or he doesn't qualify. So another type of policy design might be a survivor life or now second to die. So now, if one of the spouse passes away, the death benefit is not paid out. It doesn't pay out until the second one passes away. So this is where, let's say the wife passed away, the husband continues to have death benefits, continues to have life insurance coverage. A death benefit is not paid out to the beneficiaries until he passes away, the second one. Okay. Businesses can also use life insurance to protect themselves in case an important person at their company passes away. So business partners can use life insurance for business continuation. It's a prearranged purchase price, a contractual agreement to sell the other person's part of the business. And it makes money available to purchase the interest of the deceased partner's ownership rights from their beneficiaries. So let's say, you know, I start a business with my good friend Sandra, and we want to start a bakery. And we want to do it vegan. And, you know, I went to school and I did all the, you know, I got certified as a nutritionist and maybe even chemist or whatever to make ingredients. I don't know. And Sandra is really great at marketing and all this stuff. Well, let's say we go into business and then I get ill and I pass away. Sandra doesn't have the nutrition certification, the chemistry, you know, degree that I do. And so now she's lost half of her business. And of course, in my will, I left my part of the business that I invested in to my husband. I'm gone and she is now in business with my husband, who doesn't even like baked goods, who has no interest in vegan anything. And now she has to figure out a way to be in business with him. So this type of life insurance that our business would have had would give her the funds to buy out my husband so she can now own 100% of her business again and move forward in finding the right business partner or whatever she wants to do with the business. So this is really great because you may not want to be in business with your friends' children or their spouses, and who may have different vision or idea of what to do with that business. So it's really important for business owners to have some kind of plan like this in place. A key employee is another type of insurance policy. So this is where a business or a company will use the insurance policy to offset the loss or hire a replacement due to death of a key employee. So maybe you have an employee that brings in hundreds of thousands of dollars into the business, whether they're a headhunter or that they do the marketing or whatever they might do. And so this would be a policy that you would use, because if you lost that person, you would basically lose the business that they bring, and now your business is at a loss, your income is at a loss. And so that would be a key employee policy. The basic thing you need to know about these is, with these types of policies, the business is the owner and the payer, and there must be an insurable interest due to the financial loss between the two parties. Okay, so next we're going to go over the different terminology that you'll need to know when submitting a life insurance application. Okay, so the different parties of the contract is the owner and the applicant, which is a person who has control of the policy during the insured's lifetime. They have the power to access cash value, to surrender the policy and change the beneficiaries. And then you have the insured, whose life is being insured. So sometimes, like with my policy, I own a policy on myself. I am the owner and I am the insured. I also own a policy on my father. I am the owner and he is the insured. And then the beneficiaries are the third parties in this contract. So the beneficiary is a person that's entitled to receive the death benefit of the policy at the passing of the insured. So here, the owner, in this one, this is a two-party contract. This is where the owner is the same as the insured. So that's one party, and the insurance company is the second party, okay, in this contract. And this would be a third-party contract, where the owner is different from the insured, and then, of course, the third party is the insurance company. Okay, I mentioned earlier insurable interest. So in order to purchase an insurance policy on anybody, the owner must possess an insurable interest on that person. And that's typically based on a financial responsibility, and it must exist at the time of the application or policy issue. So a son buying a policy on the mother, the insurable interest there is that in her old age, he may become responsible for her care. He may move her in to his home and provide room and board. He may pay for her, assisted living facility or caregiver. And so there's a financial relationship there in providing care for his mother. Businesses, like I just mentioned right now, there's a financial responsibility, because if you lose your business partner, you basically lose the income that they contribute and bring to the business. And in this case, all of you that are now members of World Financial Group and are getting licensed, this one would apply to you. There is no insurable interest in you and your agent that you brought into this company. It doesn't matter that when they make a sale, you earn an override. When they don't make a sale, you don't earn an override. That is not the same type of insurable interest. So you are not allowed to buy a life insurance policy on your team members, okay? This is really important because I might see my neighbor who's like 89 years old and think like, oh, I should buy, I'm good friends with her. I'll have her, sign off, and I'll pay for a life insurance policy on her because I know it's only a matter of years before she passes away, and then I get a payout. There is no insurable interest between me and my neighbor. Okay, there's no financial loss when she passes away. So I don't qualify to buy a life insurance policy on her. Okay, question. What is the main purpose of insurable interest? Is it to allow someone to buy a life insurance policy on any person they choose? Is it to establish a new form of gambling, to protect and preserve life against foul play, or to experience a profit if someone were to die? What do you guys say?
Protect
C.
and preserve life against both.
Protect and preserve. C.
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 Okay. Okay.
C.
So
C.
I mostly hear C. So the answer is C. Okay. Okay, it might seem like, weird because why I have a life insurance on my dad and, there's no foul play, so why would it be that? And, right here, basically, you want to pick the best out of the three. We definitely know that you cannot buy life insurance on anybody you choose. We definitely know it is not a new form of gambling. Oh, let's see when is this person going to pass away and make a profit, and it's definitely not to make a profit. So C is the best of the three, and it's just, you may feel like, well, there is no foul play against my parents or my children, but it's to protect and preserve the life of them. Okay, many people ask this question: what if the insurance company goes bankrupt? And so that's why there is something called the State Guarantee Association. And so, in a very rare case, the State Guarantee Associations act as a safety net to protect policyholders if the insurance company that issued an annuity or insurance policy had insufficient assets and can't meet their financial obligations. So if they can't pay the claim, then the Insurance Guarantee Association will step in. And so the best way I can explain this is an insurance on the insurance company. So you really don't need to worry about this. For those of you that might still worry about it, to be honest, the very few insurance companies that have kind of shut down their divisions never really went out of business or their clients were at risk because other insurance companies came in and bought those clients. So those clients never lost their coverage. They still have policies that are grandfathered in that are, will be paid out as long as their premiums are paid. And so that's why, there's safeguards in place for that. Okay, so as a licensed agent, we aid in limiting exposure to money laundering, tax evasion, and other financial crimes. So those of you that are new to this industry, you will soon find out that life insurance or the life insurance industry is a very attractive place for money launderers to want to wash money or hide money. And so you will learn how to recognize some of these red flags. For right now, you just need to understand more or less what fraud is. But after you pass your exam, you're going to take a continuing education course on anti-money laundering. So don't worry about all the specific details. You won't need them for this exam, but you will be learning about them once you are licensed. And so some red flags is rapid movement of funds. Let's say I have a client and he's like, oh, I want a policy. Can I dump in $50,000 in it? And how quickly can I take out money? Can I take out money within the first month? Right there is already giving me a red flag because I've explained to him this is a long-term plan. This is a plan for long-term planning. And so if he's already considering doing movement like that, it may be to wash money. Now, there might be legitimate reasons, but you definitely want to make sure that you ask all the right questions, and you'll learn how to do that in the anti-money laundering course afterwards. If they inflate their financials, if there's unrelated third parties, or if they have cash-intensive businesses and they can't explain where the money's coming from that they're putting in the plan, because money laundering tends to happen within these types of plans, we are expected to ask certain questions. And if they can't answer these questions, then you definitely want to make sure that you can recognize those red flags. And then also, fraud represents intentional deception. And so an example would be as an agent, writing business with no intention to place this policy in order to receive the commissions or the advances or the promotions, that's fraud also, and you can lose your license for that as well. So you want to make sure that you do it right, you do it with pride, and you don't take advantage. You don't misuse your license. Okay. So now let's go into underwriting. Okay, this is a process after you submit the application. And so submitting the application is the first step. Then there's underwriting, and then there's the decision and delivery. So the purpose of underwriting is to determine whether to accept the risk of the applicant and insured applying for the coverage. So getting approved for life insurance is a privilege. It's not a right, and not everybody will get approved. And some reasons may not just be because of their age or their health, but it might be for not being able to disclose certain financial details as to why they want this policy. So during the underwriting process, you may see the underwriters requesting or reviewing these different reports, and they use this information to help determine the insurability and the rate class of the client. So they're going to look at all the questions and how they were answered on the application. They're going to request the client's attending physician statement, which is pretty much going to have their most recent medical visit summaries to find out, did the doctor have a referral for them to go see a specialist for a certain cause or reason? If there wasn't enough information on the attending physician statements, if the client hasn't recently done any type of blood work, then the insurance company is going to require or request blood work to be done. So they'll send a nurse to the client's home to do a blood and maybe urine sample. And then also insurance companies have access to what's called the Medical Insurance Bureau, the MIB, and they can look up the health history of everybody all the way from 15, 20 years ago. So after submitting an application, the client might get an email with questions saying like, are you still taking this medication from 10 years ago? And the client can just say no, but they may be surprised how I didn't give this information, how my doctor doesn't even know about this. Was when I lived in another state. How do they know about this? It's because insurance companies have access to the MIB. And they'll also pull up your driving record. Remember I mentioned earlier about statistics and law of large numbers. They're not just looking at your age and your health. They're looking at your risky activities. And so they want to see, have you had, driving record problems, whether it's speeding, DUIs, or any kind of dings on your record. So I mentioned these earlier too. There's two tables that you should understand the difference between. There's the mortality and the morbidity table. And so you could be approved for life insurance, but denied for certain riders. And so the reason is because underwriters look at the statistics for both of these. Mortality is the likeliness of you dying. And so that's why they're looking at your health questions and things like that, your medical records. And the morbidity is going to be based off of the questions, asking about what kind of work do you do? What kind of risk activities? Do you drive a motorcycle? Do you jump out of planes? Do you do things like that that could probably cause more injury or illness as opposed to people that don't do those things? Okay, we've mentioned risk and rate classes. So getting rated or getting declined doesn't mean that you're going to die. The rate classes are based on the law of large numbers. So if you apply for life insurance and they decline you, they don't approve you, they don't offer you insurance, it doesn't mean that you're dying. It just means that you don't fall within the parameters of a client they want to insure. They feel you might be too much of a risk. So here's a table to help you see the difference in the premiums based on the rate classes. And you will want to set an expectation with your client when you're filling out the application. So let's say, from Preferred Plus, this is somebody that is in outstanding health. Okay. And then maybe preferred might mean they might be a bit overweight or they might be taking high blood pressure medication. Um, and then standard might be that their health is a little bit worse. And then the more, in decline your health is, the more in decline the rate classes are. And so you could see right here, a non-smoker versus a smoker. So outstanding health non-smoker for $500,000 whole life policy, 30-year-old male, his premium might be $368. But if that outstanding health smoker applied for the same policy, it would be his premium would go up to $444. So they're going to charge him more because he's a smoker. Now, if he wasn't preferred, maybe he's standard, he has some health issues. For the same policy, instead of 368, it's going to go up to 394. They're going to charge you more based on those statistics and the rate class that you are. And, the easiest way I can look at this is, the more health risks, then the more likely you're going to probably pass away before someone who doesn't have those health risks. And so they're going to collect a bit more premium in advance before they have to pay out a death benefit. Okay, question. Who are the potential parties that must sign an application before underwriting can begin? What do you say?
Applicant, insured, and the agent. B.
Okay, I hear B.
B.
Does anybody have a different one?
B.
B. Yeah, then boy, yes.
Okay, so the answer is B. Okay, definitely it's not the beneficiary. When you buy a life insurance policy, your beneficiaries who you're going to leave the life insurance to, they don't need to sign. They don't even need to know that you bought a life insurance and are leaving it to them. So that would eliminate A and C. And then it has to be B because the agent, you guys getting licensed, have to sign the application too. That you are confirming that all the information you gathered, the information you are writing on the application is true to the best of your knowledge. Okay, good. So let's talk about some riders. Just like buying a car, riders are optional features that you can add to a policy to customize your life insurance for an additional cost. So we're going to look at a couple different riders. The first one is called Other Insured Rider. Oops. Other Insured Rider. And so this is additional coverage, additional person that's covered on the policy, usually a spouse to age 65, and or your children's rider that's convertible once they turn 18 to 21. A guaranteed insurability rider. This allows the insured, the person who's covered on the policy, to purchase additional amounts of life insurance at future dates without needing to take a physical exam or prove insurability. And so this is limited to a specific age. So just because you might have this rider doesn't mean that you can wait till whenever you want to add more insurance. You only have a specific timeline to do that. And additional insurance is based on when you bought the policy. Okay, return of premium. Many people have heard of this rider. This is where it returns premium at the end of the contract. Not all policies, and this is another thing, not all policies have all these riders. So these are riders that exist, but that doesn't mean you're going to find them on every policy. A payor rider means that it's for juvenile policies, and the premium is waived if the payer dies or becomes disabled. So let's say the mom bought the policy for the child, the mom is paying it, and the mom passes away or becomes disabled and can't work anymore to make an income to pay the policy. So the premium would be waived until the insured, which is a child, turns 21. At that point, the child, which is now a young adult, can continue to make the premium payments to keep this policy alive. Let's see, waiver of premium. So these are riders in case clients are worried about paying premiums if they get disabled. So this is where the premium is waived if the owner becomes disabled for more than 6 months. And the dividends are still paid. The cash value can still grow. So even though the client is no longer paying into the policy, the money that's already in there can grow, continue to grow with interest. And this rider expires. It's not for the entirety of the policy. It'll expire at age 65. So if this person becomes injured, okay, they still need to continue paying the policy while they're injured the first 6 months. If they are injured and due to that injury disabled for more than 6 months, then the rider will go into effect. This policy now doesn't have to pay premiums, and the premiums that the client did pay in the first 6 months of being injured or disabled, they will be refunded to the client. So basically, you have to prove that you are disabled for 6 months before this rider can go into place. Another rider was the waiver of premium with disability income. So this is the same as the waiver of premium. It pays monthly income due to the disability, and it's a typical rider that pays only 2 to 5 years. And the disability income is a percentage based on the policy amount. Okay, question. W has a waiver of premium with his universal life. He suffered a disability due to illness for 18 months. How many months will his premium be waived?
C.
18 months.
C.
Okay.
C.
So I'm hearing all. Okay, I'm hearing all C. Good job. The answer is C. Yes, for 18 months. Because he suffered a disability. Okay, he has a waiver of premium. So, and it was for 18 months. So yes, he's still going to pay this policy for the first 6 months, but because he's disabled still, those 6 months will be refunded back to him, and it'll be paid out for the entire time of his disability. Okay. Accidental death and or dismemberment, commonly referred to as AD&D. This provides additional death benefit if the cause of death is an accident. And sometimes there's a multiplier of the coverage 2 times to 3 times. And the death must occur within 90 days of the accident, okay? This is one where, I've been in the industry for a long time, and many people will have the same story like, oh, I know somebody who had an insurance policy that never paid out. I don't trust insurance. Okay, usually it's because they probably had one of these. And when I run into people who have an AD&D policy, usually they buy it from their local bank, or maybe a AAA, type company, and they don't realize the rules for this. So you see in the first bullet point, number 1, the death has to be from the accident. And in the third bullet point, the death must occur within 90 days after the accident. So if you have an accident, okay, you have this policy, you might get that paid out. But if they rush you to the hospital, they hook you up. Modern medicine keeps us alive now for a very long time. And you live past those 90 days, but then you still died from that accident on the 95th day. You died from that accident, but it was not within 90 days. This policy is not going to pay out. Okay? Because remember, you have to die within those 90 days. So that's the risk why this policy doesn't pay out. This other one is called ADB, Accelerated Death Benefit Rider. And so this is for a terminal illness. And so if you are told you have a life expectancy of 12 to 24 months or less, then you may receive a percentage of the death benefit paid out in advance so that you can decide what you want to do with those monies. Okay, so question. John has type 2 diabetes. He had his right leg amputated, and then 7 months later, he died from the same illness. He has a $100,000 life insurance, plus AD&D rider with double indemnity, with $20,000 principal sum and $10,000 capital sum benefit. how much will his beneficiary receive? What do you say?
B.
D.
D like a book.
100K.
B.
He died of diabetes.
Okay.
It's D.
It's a
Okay.
B.
I hear everybody. The primary answer was D. Correct. So in this question, you're going to see a lot of questions like this on your exam. They added a lot of extra information that you don't really need for the answer, but they did it to confuse you. So you're going to take longer to read this question over and over to try to figure out what are they asking for. So let's break it down. He has type 2 diabetes. He had his leg amputated 7 months later, and then he died from the same illness. Okay, so he has $100,000 life insurance, and he died. So $100,000 is going to get paid. Okay, AD&D rider with double indemnity, that's the extra fluff that they added. You don't need to worry about that because he died. He passed away, and his death benefit got paid out. Okay, another rider, you can add a long-term care rider to a policy. So the purpose and how you qualify for these accelerated benefits would be, if you aren't able to do 2 of these 6 daily activities, if you can't bathe yourself without assistance, you can't toilet without assistance, dress yourself, eat, if you have incontinence, or even just transfer yourself, get up from bed to move to a chair. If you can't do any of those without assistance, 2 of those. 2 of those, you qualify for long-term care, okay? Or you also qualify for long-term care if you are determined to be a person that suffers from a cognitive impairment, such as Alzheimer's, stroke, or some other mental dementia. Okay. It's important also to understand and be able to explain to the client about conditional coverage. So what if you pass away while your application is in underwriting? Coverage is effective on the condition that the applicant is proven to be insurable on the date of the application or the medical exam. Okay, so generally you can be conditionally covered. You're conditionally covered. So let's say tonight, we sit down, I explain the life insurance, you want it, we fill out the application, and tonight you may be conditionally already covered if these 3 things are submitted to the insurance company. The application, the initial premium, and the medical exam. So, for example, a healthy applicant dies suddenly while still in underwriting. If the client was conditionally covered, the insurance company would continue underwriting her application. If they would have approved her application, then they would pay the claim to the beneficiary. Now, you got to check with every company for their individual rules, but this is generally applies to everyone. So let's take a look. We'll come back to that. Right now, we're going to go ahead and look at what is free look period, okay? Because now we're going to talk about delivering the policy. After the policy is issued, it's important for the agent to deliver the policy to the client and review all the information. Once the policy is delivered, the free look period begins. And the free look period, it's a specific window that a client can change their mind for any reason and cancel the policy without penalty and receive a refund on the initial premium. Okay, so the free look period is usually between 10 to 30 days, and you'll need to definitely check what the free look period applies for your own state, but every policy will have this. So let's go through a couple questions to see how we understand all of this. And here we go. January 11th, the insurance company receives the application and initial premium. On January 16th, the insurance company receives a medical exam and applicant now meets rules for conditional coverage. February 22nd, the insurance company approves application and issues the policy. And February 26th, the agent delivers the contract to the client. So question, on what day does the client qualify for conditional coverage?
B.
January 11.
A.
January
A.
16th.
It's B. Is
Okay.
A.
B.
Okay. Thank
B.
you. So the answer is
Is-
actually B. Okay, because for conditional coverage, you have to remember you need all three to qualify: the application, the initial premium, and the medical. Okay, so on January 11th, the insurance company only had two. On January 16th, they received the medical exam, so now they have all three, and this applicant now meets the rules for conditional coverage. On what day does the free look period begin? January 16th, February 22nd, or February 26th?
February 22nd.
C.
Okay. Okay, so I heard all three, and the answer is C, February 26th. So once the client, so on February 22nd, the insurance company approved the application. They looked at everything and they said, we will offer this client life insurance. And then they issued the policy. After they issue the policy, you as the agent needs to go deliver the policy to the client. Once you deliver the policy to the client, their free look period begins. So they receive the policy, whether it's physical or electronically, and now they have 30 days to review what they just bought and either change their mind or continue with it. Now, if the client accidentally dies on February 1st, would the insurance company pay the claim? What do you say?
Yes.
Yes, it pays.
Yes.
January 11.
Conditional
Okay.
coverage.
Yes.
So the answer is yes, because even if the client died on February 11th, before that, the company received all three items, making this policy having conditional coverage, meaning they're going to continue doing all the underwriting. They're going to continue to take a look to see if this person is insurable. And if they would have said yes, then they would pay the policy as if the client, were alive during the underwriting process. Okay, let's try some more. January 11th, the insurance company receives application, medical exam, and initial premium. January 16th, the client passes away from a car accident. February 22nd, the insurance company declined the application due to the client's medical exam results and returns the initial premium. So question, on what day does the client qualify for conditional coverage?
January 11.
January 11.
11.
A.
A.
Yes, January 11th, because they received all three items: application, medical exam, and premium. And then when the client accidentally dies on January 16th, does the company continue to do underwriting?
Yes.
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 The answer is yes, because they received everything. They're going to continue to review the application, request all the medical records, and decide if they would have insured this person. Now, when the client accidentally dies on January 16th, would the insurance company pay the claim?
No.
Yes. Yes.
Okay.
Yes.
So the
No.
answer is no. So because even though, let's say if the client did not pass away, the insurance company eventually would have come to the decision after requesting the client's medical records or results that this would not have been a client they would have insured. They would have declined this application. So even though they got all three items, conditionally covered doesn't mean they're automatically a client. It just means they're going to go ahead and still do the underwriting to see if they would approve this client. And so even though he passed away, no death benefit is going to be paid out, because in the end, after reviewing everything, the insurance company saw that this would not have been somebody they would have insured. So no death benefit would be paid out.
C.
Okay, here's the last one. January 11th, the insurance company receives application and initial premium. January 16th, the insurance company approves and issues a policy. And February 22nd, the agent delivers a policy to the client. February 26th, the client passes away. So does the client qualify for conditional coverage?
Yes.
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 Okay, you're all wrong. The client does not, because the insurance company only received application and initial premium. Even though they didn't need the medical records, they went ahead and approved. They may have, pulled up, it might have been a young client. They might have seen from the MIB that this client has no medical history to be concerned about, and they issued it right away. But there was no conditional coverage because there was no medical results done. Okay, so it's okay because this client still got approved. They got approved really quickly, which was great because they passed away right away, but there was no conditional coverage. If the client accidentally passes away on the 13th of January, would the insurance company pay the claim?
No.
No.
No, B.
Okay, the answer is no, because even though they would have approved it, we already saw that this client would have been approved. There was no conditional coverage. The conditional coverage is the only way for a deceased person's policy to be paid out. And unfortunately, all the insurance company got was the application and the initial premium. The insurance company didn't need any medical results, so there is no conditional coverage. When the client dies on February 26th, will the insurance company pay the claim?
Yes.
Yes.
Okay. The answer is yes, because on the 16th, this client was approved. The policy was issued. The policy was delivered to the client. Everything is done. And so then the client passes away, so a death benefit was paid out. Okay. So another thing that you need to understand about insurance policies is a trial application. So clients can submit an application without paying the initial premium and still go through the underwriting. Okay, so since no initial premium is submitted, the applicant does not qualify for conditional coverage because they don't have initial premium, and full coverage is effective when the policy has been issued. So a reason why you might do a trial application is, let's say a client has many health concerns, health issues. Maybe they shared with you that they were already declined life insurance a few years ago, and now they want to see if, with some health changes they've had, will they qualify now? So you might go ahead and submit a test application or trial application in which you gather all the same information, fill out the application. They're going to request all the medical records and do the full underwriting, but the premium doesn't have to get paid. That way, if this client still is in kind of that no decline phase, you don't have to do that whole waiting period of refunding the money. So here we go. On January 11th, the insurance company receives application without premium and underwriting begins. So it's a trial application. January 16th, the applicant completes the medical exam. February 22nd, the insurance company approves and issues the policy. And February 26th, the client submits initial premium and agent delivers the policy. Here's our question. What day is the policy effective?
February 26th.
26. C.
Like I heard 22nd and 26th. It's going to be
22nd.
26th because on the 22nd, the insurance company approved. They said, we looked at all the information you submitted, and this is somebody we'll go ahead and offer life insurance. We'll issue the policy, but no premium has been paid yet. So once the client pays the initial premium to start the application, then the policy is complete. If the client accidentally passed away on February 23rd, would the insurance company pay the claim?
No.
Yes.
No.
Yes.
Mm.
No.
No.
Okay. I
No.
hear more no's, so the answer is no.
No.
Because even though on the 22nd, the company said, yes, we'll give you insurance. We issued the policy. There's
No
no
premium
premium.
was paid.
There's no premium. So the policy is not complete yet. Okay. Let's talk about incontestability clause. This protects both the insurer, which is the insurance company, and the consumer. So here's some examples so that you can understand them. It's typically a 2-year clause to detect fraud, errors, or misstatements at the time of the application. So how it protects the insurer, the insurance company. If a client passes away within the first 2 years of the issue date, the insurance company has the right to review and investigate whether the client gave incomplete information. If the insurance company can prove that false or incomplete information was misrepresented on the application, they do not have to pay the claim. Okay, so this would be, let's say I apply for life insurance and the application asks, do you smoke? And I say, no, I don't smoke. And then I die a year and a half later of lung cancer. So if they find out I died because I was a smoker, then basically I lied on the application. This contract is now void and invalid. They're going to refund the money and basically there's no death benefit is going to get paid out either. So they have 2 years. Okay. Now, if I die after 4 years from lung cancer because I'm a smoker and they never found out in the first 2 years, well, then I got away, death benefit is paid out. Now, how this protects the consumer is if a client's health changes and passes away in the 3rd year of the policy, the insurance company must pay the claim because they only have the first 2 years to contest this contract. Remember, a life insurance policy is a contract. It's a contract between multiple parties. I said this and you made a decision based on that information. If you find out that I lied or gave incomplete information within the first 2 years, they can void this contract. That's the incontestability clause. Included in here is called the suicide clause. Many people have heard about this. So suicide is not covered in the first 2 years of a life insurance policy. Okay? If it occurs, the insurer will be refunded all the premiums to the beneficiary. The company will refund all premiums to the beneficiary. Basically, it voids. It cancels this contract now. It's part of the incontestability clause. Suicide can happen after 2 years, but if it happens within the first 2 years, this contract is void and no death benefit is paid out. Underfunded policies. What if a client misses payments? There are 2 periods that you need to know about. The grace period, this protects the insured and the policy owner for 31 days after the premium due date before the policy lapses. And then there's reinstatement. So if a cash value policy lapsed because there was no more premium was paid, you can reinstate within 3 to 5 years by providing proof of insurability. So you need to prove that you're healthy and they would insure you again, and pay back premiums plus interest if required. And so you'll want to check with individual states and the insurer for their own requirements too. Okay, beneficiaries. There are different types of beneficiaries, and you need to understand the terminology for the first, second, and third in line. And then also you'll want to understand the common disaster clause. This may or may not come up on your test, but it's in there. So if the insured and the primary beneficiary died at the same time, okay, the insurer will use a common disaster clause and they'll assume that the primary beneficiary died first so that the death benefit can be paid to the contingent beneficiaries, which would be automatic because the insured and the primary died together. So it goes to the next in line, which is exactly what contingent means, next in line. Okay, beneficiaries. You can make them revocable and irrevocable. Okay, revocable means that the client can add or remove beneficiaries without their consent. This is pretty much the normal type of beneficiary, okay? You can decide at the time of application to name all your kids, and then next month you can add your grandchildren. You can remove some kids. You can change your mind whenever you want. You do not need the beneficiary's consent to do that. Irrevocable, you do need their consent. So the client must get consent from the beneficiary from making any changes. Typically, people only use irrevocable for estate planning purposes. You know, when you have large estates and, you know, there's just going to be more legalities in place regarding the death benefit. Okay, question. B would like to change a revocable beneficiary, which is true. B needs to notify the beneficiary of intent of change. B needs to call his agent and trust that he or she will take care of it. B needs to get signatures from the new beneficiary and submit it to the insurance company. Or B needs to fill out a change of beneficiary form and submit it to the insurance company. What do you say?
D.
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 Okay. I hear D, correct. So remember, this is a revocable beneficiary application, so you do not need to notify the beneficiaries of any changes. You do not, the agent they can't submit it on your behalf, like in B, because it's going to need the owner's signature. And B does not need to get signatures from the new people that they are adding to the policy. So it is not A, B, or C. Okay. We're almost at the end. So death benefit settlement options. So most people, when it comes to death benefit, will choose the lump sum option when it comes to paying out the benefit to the beneficiaries. Beneficiaries that's when they receive the entire death benefit in one-time payment. But in case clients are worried about the beneficiaries getting too much money at one time, there are other settlement options. Okay, so fixed period basically means that instead of taking everything at once, you're able to receive the death benefit over a specified length of time, such as 20 years. And that option may make sense if you have predictable expenses like a mortgage still to pay and you just want to make sure that you don't run out of money before those things are paid off. So it's meant to simulate the income of the deceased person. Fixed amount is instead of a fixed time period, it's a fixed amount settlement structures like in a fixed monthly payment. And so that payment will last until the principal and any earned interest are depleted, are gone. And your beneficiary may have the option to raise or lower that fixed amount. And although this may prevent beneficiaries from spending, their death benefit all at once, benefits may still deplete quickly if the fixed amount is raised too high. Interest only means that the insurance company holds the principal of the death benefit and pays only the interest that's being earned on that. So any interest earnings will be paid out, and you typically can take a full or partial withdrawals almost at any time if you need money. And then the last one, lifetime income. This would be a lifetime income as like a single premium immediate annuity, where you kind of turn it into a pension, and the death benefit is placed into an annuity one time, and then the benefit begins to pay out immediately. And you can receive payments that are designed to last for the entire life of the person based on their age, just like you would a regular annuity. Okay, we did it. So that was 2 hours of life insurance. And so your next step is definitely make sure, if you want to review this information again, we're doing this workshop 1 again tomorrow morning, 7 a.m. Pacific time. And then on
Please, can we get this slide?
on Thursday, we will be doing annuity. So workshop 2 will cover annuities, which are life insurance products. And so you're going to see that on your exam. Annuities, disability plans, and Medicare government plans. So that's going to be coming up in workshop 2. So I just want to remind you all that this information in the workshop, it does not replace any of your state requirements that you'll need for your exam. I had mentioned earlier, in California, we are required to do 52 hours of pre-licensing courses and submit a certificate that we completed that to get our license. Other states don't need to do that. And other states only need to do a certain number of hours. So please make sure you find out what are your requirements in your state, because we have people on here from all over the nation. But basically, this information you learned today, it's going to apply to everybody. There's going to be specific rules and timelines for each state, but everything you learned here is going to help everybody for your test and help you understand the terminology and the concepts that you're reading in those online courses. Okay, so good luck to everybody. I hope that you all have your exams scheduled, because I don't know about other states, but in California, we are so backed up that if you feel so confident and ready to take your test today, you might not be able to for a month and a half to 2 months later, because there's no dates available. So if you're just starting to study, I would recommend go online right now and pick a date so you have it locked in, because you could always maybe change that date as you get closer and maybe you're not ready, but you can't get an earlier date. Okay, so that's just my final tip to you all. Thank you, Sandra, for being on here and helping with us. And I hope to see you guys all on here throughout the week.
Good luck, guys.
Thank you.
Night.
Have a good
Thank
night.
you.
You're welcome.
Bye.
Share,